In 1994, a hedge fund called Long-Term Capital Management opened for business. Its founding team included John Merriweather, one of the most successful bond traders in Wall Street history. Its principals included Myron Scholes and Robert Merton, two academics who would share the Nobel Prize in economics in 1997 for their work on derivatives pricing. The fund also employed several former Federal Reserve economists and a roster of PhDs from the most prestigious quantitative finance programs in the world. The fund's strategy was, at its core, a form of convergence arbitrage. Identify pairs of financial instruments that were mispriced relative to each other, take positions on both sides of the mispricing, and wait for the prices to converge to their historical relationship. The positions were hedged. For every dollar of risk taken on one side, a corresponding position reduced the risk on the other. The strategy was designed to be market neutral. It should make money regardless of whether markets went up or down, because it was betting on the relationship between instruments rather than on the direction of the market. The strategy worked. In its first full year of operation, the fund returned 21%. In 1995, 43%. In 1996, 41%. In 1997, 17%, lower, because the fund had become so large that its positions were affecting the prices of the instruments it was trading, compressing the spreads that the strategy depended on. In 1998, the fund lost $4.6 billion, approximately 90% of its capital, in less than 4 months. The Federal Reserve organized a bailout involving 14 major financial institutions to prevent a collapse that regulators believed could destabilize the global financial system. The variable that the fund's extraordinarily sophisticated models had not accounted for was one that, in retrospect, seems almost obvious: the possibility that markets could become temporarily illiquid in a way that prevented the convergence the strategy was waiting for from occurring before the fund ran out of capital. The LTCM models were built on a foundational assumption that is standard in quantitative finance, that the historical relationships between financial instruments represent the relationships those instruments will maintain, and that when deviations occur, they will revert. This assumption is not unreasonable. Historical relationships in liquid markets do tend to mean revert. The models were calibrated on decades of data. The positions were hedged. The risk was, by any standard measure, managed. What the models did not adequately account for was a tail event, a scenario outside the distribution of historical data, in which the assumption of liquidity failed simultaneously across multiple markets. The specific event that triggered the LTCM collapse was Russia's default on its government debt in August 1998. The default caused a global flight to quality, a sudden and massive movement of capital from risky assets into safe ones that affected markets far beyond Russia, and that was correlated across markets in a way the historical data had never shown. The positions LTCM held were, in normal market conditions, hedged. In the conditions of August and September 1998, the hedges failed because the correlations between instruments changed. Assets that had historically moved independently began moving together in the same direction at the same time. The fund was not, in those conditions, market neutral. It was massively exposed. The question the LTCM team had not adequately asked, and this is not a retrospective criticism because the question is genuinely difficult, was, what does our risk look like in a scenario where our core assumption about market liquidity fails? Have you ever worked with a model or a plan whose risk assessment was based on historical data and discovered that the scenario you encountered was outside the distribution the model was calibrated on? Leave a comment. There is a specific argument that defenders of LTCM's approach have made in retrospect, and it deserves honest engagement rather than dismissal. The argument is that LTCM's models were not wrong about the long-run relationship between the instruments it held. They were correct. The spreads that LTCM was betting would converge did converge. Eventually, if LTCM had been able to maintain its positions through the liquidity crisis, the trades would have been profitable. The fund lost, not because its analysis was wrong, but because the leverage it had employed, approximately 25-1 on equity at the time of the crisis, meant that the fund ran out of capital before the convergence it had correctly predicted actually occurred. This is accurate, and it contains the specific variable that the fund underestimated, the relationship between leverage and time horizon. LTCM's models were designed to assess the probability that a trade would be profitable at convergence. They were not designed to assess the probability that the fund would remain solvent long enough to reach convergence in a scenario where the path to convergence involved a period of mark-to-market losses large enough to trigger margin calls that the fund could not meet. The variable that was underestimated was not the direction of the market. It was the time the market would take to converge and the capital the fund would need to survive that time in a scenario where the market moved against the fund before it moved toward it. This is the specific cost of underestimating one variable, not that the entire analysis was wrong, but that the analysis was correct about the outcome and wrong about the path. And the path, not the outcome, is what determines whether you survive to collect. If the precision of this distinction, right about the direction, wrong about the capital required to survive the journey, is the level of analysis you come here for, the like is the direct signal. The bailout organized by the Federal Reserve in September 1998 involved 14 financial institutions that collectively held LTCM's counterparty risk. The Fed did not provide government money. It organized the banks that were most exposed to LTCM's failure, banks that would have suffered significant losses if LTCM had been forced to unwind its positions into illiquid markets, into a consortium that injected $3.65 billion in exchange for a 90% ownership stake in the fund. The existing investors, who had provided capital at a moment when the fund had returned 40% annually for multiple years, saw those returns effectively erased. The principals of LTCM, who had significant personal capital in the fund, also lost substantially. This is not a story of people who took risks with other people's money and walked away unharmed. The institutional investors who had lent to LTCM at 25-1 leverage did not have a particularly strong claim to be surprised by the outcome. The leverage ratio was disclosed. The strategy's dependence on market liquidity was implicit in how it worked. The sophisticated quantitative models that LTCM used were not opaque to the banks that were extending credit. The banks made a judgment that the downside scenarios were sufficiently unlikely to justify the returns from lending at that leverage ratio. The Russia default produced a scenario that was outside that judgment. The employees who were not principals, the quantitative analysts, the operations staff, the technology team, were employed by an organization whose risk was, for most of its operating history, invisible to them in any practical sense. They worked in an environment defined by extraordinary intellectual rigor and by returns that felt like validation of that rigor, until the validation disappeared in less than 4 months. The practical lesson from LTCM is not about leverage exactly, though leverage is part of it. It is about the specific relationship between the confidence that a model produces and the cost of the variable the model does not include. LTCM's models were among the most sophisticated ever built in financial markets. The confidence they produced was, on the model's own terms, justified. The trades were correctly analyzed on the assumptions the model made. The variable the model did not include, the possibility of extended illiquidity in a scenario where the assumed correlations failed simultaneously, was not included because it was outside the historical distribution the model was calibrated on. The cost of that omission in 1998 was 4.6 billion and a near systemic event. The practical thing. Any model, plan or analysis is a description of how something will work under the conditions the model assumes. The most important question to ask of any model is not, does this work under the assumed conditions? It probably does, or it wouldn't have been built. The most important question is, what is the cost of the variable this model does not include in the specific scenario where that variable is the one that matters most? For LTCM, the variable was liquidity. For Boeing's MKS safety model, the variable was a single sensor providing erroneous data. For WeWork's business model, the variable was what $1.9 billion in losses looked like to public market investors when stated transparently for the first time. In each case, the model was correct about most of what it included. The cost came from the one thing it left out. The next episode looks at the organizational tendency that creates the condition for these omissions, the specific psychological mechanism by which the people who build models systematically underestimate the uncertainty in domains they know well. This content was developed with the support of artificial intelligence tools and underwent human review, editorial curation, and approval before publication. The analysis presented here is strictly educational and philosophical in nature, grounded in behavioral psychology and classical stoicism.